We introduced autocorrelation last week. I think it was a little, maybe a little tricky to understand because we didn't have an example. So today I wanted to show an actual example of what this looks like when we specifically look at stock returns. I know that I wanted to point this out. Last week we were kind of looking at it from the perspective of price, but there's a number of different reasons why returns are really what you would want to use when you're trying to study something like autocorrelation. So that's the context of the example that we're going to be looking at. But first, to introduce what we are talking about. Last week we introduced autocorrelation, and just to kind of recap what it is, that basically describes how similarly an underlying moves compared to lagged versions of itself. And we're going to look at an example that hopefully makes this, or gives us a little bit of context. But really, autocorrelation is looking at how much the current values in a time series are related to the past values. And our time series can be a bunch of different things. We could be looking at volatility, we could be looking at returns, but whatever it is, that's really the broad concept of what autocorrelation measures. And so today we're going to look at like how you would really detect autocorrelation in a little bit more detail and what an actual example would look like with returns data. Does that make sense?
Yep.
So a little bit of recap. We got a math slide for anyone who's interested. You don't really need to understand what this means to understand how to use it, but I wanted to kind of throw it in there for completeness. But the autocorrelation function with lag k is simply the covariance between a series and a lagged version of itself divided by the variance of the series. So this is similarly how we would like calculate the correlation between two variables, so like SPY and QQQ, for example, how correlated the returns are. It's a similar calculation, but instead of looking at the returns of two different assets, we're looking at the returns of one asset and the delayed versions of that, or the delayed returns of that same asset. And the autocorrelation function for lag k would just determine like how many lags or how many days of lag that we're choosing to look at. Does that kind of make sense?
Yes.
How we would interpret autocorrelation is very similar to how we would interpret regular correlation, but similarly, the autocorrelation function tells you the strength and direction of the autocorrelation relationship. So if we have a correlation value of 1, that gives you perfect autocorrelation. So basically, the series and the lagged version of itself are identical. Which the significance of that, I put an asterisk there because I don't want this to be misused, but what we would typically consider the significance to be would be a trending relationship. So this is how we identify trending to the upside or trending to the downside. So basically, past series of itself tend to look similarly or inversely similarly to it, which is a trending relationship. If we have a correlation value of -1, it tells you perfect inverse correlation. So that a series and a lagged version of itself tend to be opposite. This is really the example that we're going to look at, so just hang tight for a second. This would kind of tell you a little bit of reversion or oscillation is measurable in the signal. And when you have a correlation value of 0, similarly to regular correlation, this tells you that the series and a lagged version of itself are basically unrelated and there's no observable relationship. And I think that the numerical values of this are going to make a little bit more sense when we look at the example, but does that make sense so far?
Yes.
Fabulous. So detecting autocorrelation. There are a number of ways to do it, and the way that you detect autocorrelation is going to really depend on the type of signal that you're working with. But the primary ways to kind of do it are by using the autocorrelation function. So just looking at that autocorrelation value for different lags, or using a statistical test such as Durbin-Watson. There's a couple different statistical tests, and again, the one that you're going to use is really depending on the case study that you're trying to look at. But the autocorrelation function plot at different lags gives you a little bit more insight into the actual structure of the autocorrelation in the specific signal. So that's really what I'm going to look at today. Make sense?
Yeah, you're simple.
Fabulous. Okay, so let's look at the actual numerical example. Hopefully this is going to give a little bit of context, but specifically I wanted to look at SPY during the first 4 months of 2024. So from January to April of 24, I want to look at the price of SPY. And specifically, I want to use the autocorrelation function to detect any kind of statistically significant similarity between the current version of the returns of this price and past variations of the return signal. So I'm going to show exactly what that looks like in a second, but effectively, I'm going to be taking the signal, transforming it into returns, and looking at the correlations between the signal itself, so the return signal itself, and different lagged versions of that. Does that kind of make sense?
Yes.
Okay, so the actual, when we look at these lags, or when we look at the autocorrelations at the different lag levels, that's effectively what this plot is. So here are the autocorrelation values for the signal and then different lagged variations of it. And this is specifically the lags with lags ranging from 0 to 18. So when we look at the lags with when we look at the autocorrelation with a 1-day lag, we're taking those returns values and shifting it by 1 day. When we're looking at the correlation between the signal and a lag of 2, we're shifting it by 2 days and looking at that correlation. I'll show the table of data in a second, but that's effectively what we're actually measuring here. And when we look at the autocorrelation plot, we can see what those autocorrelation values are for each of those different lags that we're considering. And then this sort of like blue shading area tells you the uncertainty or the threshold for statistical significance. So things that are, when we get measurements that are inside of that cone, it doesn't necessarily indicate statistically significant autocorrelation. But what we actually see is that one of these points during this area is outside of this cone, which means it is statistically significant. And here it's specifically negative autocorrelation that is statistically significant with a lag of 2. Does that kind of make sense so far?
Yes.
Okay, because this is the statistically significant point, that's the one that I want to kind of look at. So this is specifically with SPY returns and SPY returns that are lagged by 2 days. That's the one that's giving us the statistically significant value during this backtesting period that we're looking at. So what this basically means is that we have our SPY returns, and then we have our SPY returns that are lagged by shifted by 2 days, basically, that are yielding the statistically significant result. When we look at the correlation between SPY returns and 2-day lagged SPY returns, we get a correlation of negative 0.48, which is just outside our statistically relevant window, basically, or just outside our statistically significant threshold. And so what this means is that we can actually measure inverse similarity between SPY's returns and SPY returns that have been shifted 2 days. Does that kind of make sense? A little bit, yeah?
Yeah, more or less, yes. Definitely make it easier, but it's getting more clear than last week, for sure.
So let's look at this from the perspective of probabilities. So we're measuring an inverse correlation, a significant inverse correlation between SPY's returns and SPY's returns that have been lagged by 2 days. So what that means in terms of probabilities is that if you look at SPY returns and the 2-day shift of SPY returns, they have opposite signs about 61% of the time. So just looking at this, instead of from the perspective of correlation, from the perspective of probabilities, what we can see is that 61% of the time, so actually very often, if you have a positive return on day 1, there was a negative return 2 days prior. There's a pattern in the relationship that we can statistically measure using this autocorrelation. And here the 61% is just a separate calculation, but hopefully one that gives it a little bit more context. Does that kind of make sense?
Yes.
So what this means is that there's actually a statistically measurable pattern in the data. If I have a negative day today, that could mean that I'm going to have a positive return in 2 days, right? If I want to take this from a predictive perspective, but obviously there's a lot of caveats that come from that. When we look at all of these different lags, we can see that there's usually not statistically measurable patterns in the structure. So the past days don't really have a lot of similarity with the current days. But during this window, for this specific lag, I can see a pattern, right? Which I can't actually see with any of the other days. So that might mean that this is a tradable signal, for example, if we want to use it that way. Does that kind of make sense?
Yeah, it makes more sense for sure. Will that allow you to take a more educated guess on maybe a little bit of a directional assumption on the market, or not really?
So that's a great question. So specifically what we're looking at here is the closing daily price movements, right? So we're looking at daily returns for the S&P 500 during this 4-month period. And we're looking at the autocorrelation in the signal that we're potentially measuring for that type of signal. So we could modify the signal to, represent something else. We could look at volatility instead of returns. So like we could look at the VIX, for example, instead of returns data. We could look at like opening price data instead. And look at the changes there. So from open instead of close. So there's a couple different ways, or there's a bunch of different ways that we can really swap out the signal that we're looking at in this example for a different signal.
Okay.
But the problem is that you're still using historical data to try to make assumptions about the future. That's always going to be a limitation when you're looking at historical data like this. So for instance, when we look at the correlation between SPY and the NASDAQ, we can say, oh, there's been a very strong historic correlation between these. So I can maybe expect this historic correlation to continue. And we can see there have been many, many examples when the correlation actually diverges and can cause problems. that is also going to be the same when you're looking at autocorrelation. Just because we're seeing statistically significant autocorrelation for this one specific lag during this one specific period, that doesn't necessarily mean we can use it as the basis for future trading decisions or trading decisions around the future. But that being said, it can still be used as a tool for that. There's just going to be limitations. So it might be that, like, okay, during this 4-month period, we did see the similarity between, SPY returns and SPY returns that were shifted by 2 days. There might have been a pattern in there that we could detect. It doesn't necessarily mean the pattern is going to continue, but for sort of more speculative or day trade strategies, that might be a useful technique. And also for understanding the limitations that some financial models are going to have. So because we saw that there was autocorrelation for this specific signal or over this specific periodicity, that might introduce errors into the financial models that we're going to use. There's a bunch of different applications for this. Personally, I think the most interesting applications are how can we use this to model volatility more accurately? Because volatility, as you're going to know, we see volatility clustering all the time. Yep. If we have a big up move today, we might see a very big up move tomorrow or down move tomorrow. We see in volatility signals this autocorrelation much more often compared to price signals. So that's, for me, I think the most interesting application for this, because in order to really fully capture the phenomenon that we actually observe in volatility, you need to be able to account for this element of autocorrelation in the signal itself. So for me, for volatility forecasting is probably where this would be the most relevant, but we can use it for other more speculative strategies as it pertains to returns if we want to. Just to conclude, so autocorrelation measured with the autocorrelation function or certain statistical tests can be used to detect subtle patterns in time series signals that might be tradable or introduce errors into financial models. Because this autocorrelation indicates that there's a lack of independence between our variables. If we measure significant autocorrelations, it means there is a certain amount of influence in past prices with respect to future prices. While we normally assume that these return values are completely independent, today's returns don't influence tomorrow's returns at all. But when we measure autocorrelation, that means that that assumption is getting challenged. And so we need to definitely be aware of that when it comes to financial models, because independence is a very, very, very core assumption of most financial models. And then kind of leading into the piece for next week, autocorrelation can be used as the foundation for autoregressive models, which can be used to capture the subtle phenomena of volatility signals, such as volatility clustering, which is personally what I'm the most excited about. But yeah, hopefully that made a little bit of sense. Hopefully we found that interesting.